Okay, great. Well, hello and welcome. Thank you so much for joining us today for our webinar entitled COVID-19, Telecommuting and NYC's UBT, Tax Saving Opportunities for Hedge Funds and Other Professional Services Firms. Towards the end of the session, we will be holding an interactive Q&A, so please do drop any questions into the Q&A feature. And with that, I'll hand over to our speakers, Tim and Nishant.
Okay, thank you, Holly, for kicking this off. Good afternoon, everybody who's on the East Coast. Thank you for joining me and Tim. My name is Nishant. I am one of the founders of Moneo that was recently acquired by Topia. We are today going to be talking about the hot topic of UBT taxes, which has become even more relevant given the stay-at-home situation I think a lot of folks on this call and potentially your clients are facing. I have with me Tim Noonan, who requires absolutely no introduction to most folks. If you've been in the SALT space, Tim is a senior partner at Hodgson Russ, the law firm of Hodgson Russ. He is by far hands down the go-to guy for any New York State, New York City SALT matters. He's got a lot of experience on residency cases. I've worked with him on a number of cases over the last decade. So hopefully this would be a good conversation with all of us, and looking forward to Tim sharing his insights and to hearing from you guys what questions we may be able to answer for you. Tim, over to you.
Thanks, Nishant. Excellent introduction. You said everything nice about me that I told you to say, so I appreciate that. And hey, everybody. Nice to join in. I'm getting kind of used to these webinars. It's nice. I can do them in my sweatpants. I'm dressed up here, but I won't stand up. Don't worry. I got my fake background back here, so it should be good. And yeah, the topic today is a hot topic on work at home and UBT, and it's a topic that Nishant and I have been talking a lot about. It's been in the news. We'll talk about that. Also in the news, of course, COVID has created lots of, tax issues here. I actually pulled this. I don't really think this is real. I'll admit to not watching the daily press conferences, so it could be real, but I don't think it is. I think this is fake. But it was funny a couple months ago, from a tax perspective. It's not as funny now when the virus actually has moved to New York, or moved to Florida. I don't think it's the governor's fault that happened, but perhaps I'll take credit. In any case, COVID-19 in SALT. SALT, of course, is state and local taxes. And who would have thought that, a pandemic like this would have, such a huge impact on state taxes, especially in New York City, of course, given everything that's happened in New York City and all the changes with sort of day-to-day work, particularly in the city. So look, the focus here is on UBT. Of course, the pandemic has had significant impact on income tax issues in general around New York State, both for residency, people working from home. The other issue that we're going to see is I think there's a lot of chatter about rates going up. So this has caused a lot of people to think heavily about New York taxes. But the other thing is a lot of SALT measures, particularly in New York, are based on where services are performed. And particularly the tax we're talking about today, New York City's unincorporated business tax, making kind of the work at home thing be such a big deal. So the question is, in light of this, is there an opportunity to maximize the New York City savings? And we're going to spend some time talking about that. I just want to lay the groundwork for just a couple of minutes on, in general, sort of the New York State tax structure. I think it's going to impact some of the things we're talking about in the city for purposes of the unincorporated business tax. So for state personal income tax purposes, there's no UBT, right? So there's no entity level tax that a partnership or an LLC will pay in New York State. Instead, traditionally, income's going to flow through, right, to the partners or to the members, and the partners or the members will pay tax based on that flow through income. Now, when you get to the individual level, then just in general, if you're a resident of New York State, well, it's the old joke: you only pay tax on one thing. Everything, right? So if you're a resident, you're taxed on all income. If you're a non-resident, you only pay tax based on work days. Okay, so now from a COVID perspective, that raises some questions. We'll get there in a second. And if you're a non-resident member of a partnership or an LLC, well, now you're only taxed based on the source of that income, right? And for partnerships and LLCs, the regular measure that the state's going to use to allocate that flow-through income is a sort of what is now kind of an archaic, three-factor formula of property, payroll, and gross income. So you have these three factors that it'll determine if I'm a non-resident partner in a New York partnership, I'll pay tax based on the percentage of my flow-through income, not based on what I'm doing really, but based on the overall firm, what its overall percentage is going to be. We'll talk a little bit more about that in a second. So again, what's happened with COVID, and I just see this in my practice all the time, I know Nishant does as well. First, the impact on residency, right? People are fleeing, right? People are moving all over the place. Florida, Texas, whatever, there's just a lot of movement going on. So that firstly is, we've been spending a lot of our time, assisting people in these moves. Of course, they got to be a permanent move, right? You can't move to the Hamptons for 6 months or 9 months or even a year and claim that you changed your residency. You got to really land there. So that's the first thing. Second, though, the other impact is non-resident employees, right? So if you're a non-resident employee, remember on the last slide, I mentioned that you'll end up paying tax based on your work days, right? So work days in New York, work days out of New York. So at its surface, you might think, oh, sweet. I live in Connecticut. I usually would work in New York City, but now I can't work in New York City. So I'm working at home. Do I save New York taxes? Well, we have to be careful of the convenience rule. And again, this will come up in our UBT discussion. So just want to give the background. And the convenience rule says, look, yes, we're going to calculate it based on work days, but if you're working from home, if you're telecommuting to a New York office, maybe I should say, then that's treated as a New York day. Even if you're in Connecticut, even if you're in Tennessee, even if you're in Florida, it doesn't matter. New York will say if you're telecommuting in to a New York office, that's a work at home day. Now, again, it's called the convenience rule. So the idea is if you're working from home for your own convenience, then that's a telecommuting day in New York. Of course, none of us are really working from home for their own convenience, right? This is all, it was a necessity. At one time, it was a governmental requirement, right? And at least at this point, a lot of us are just here because our employers are telling us stay home. So is that a convenience day? Well, look, topic for another webinar, but our view is that the state's going to be aggressive here. They're losing money, I think, through this, like many folks. And the state doesn't want to see all of these stay-at-home employees stop paying New York taxes. So that's something to watch out for. I think we can expect the state to be very aggressive when calculating, these work days. All right, so sticking on the COVID impact concept, if you're a non-resident partner of a partnership or a member of an LLC, I think actually all these COVID changes with people working in different places, at least in the short term, probably has a minimal impact. And that gets us back to this three-factor formula. Okay, under the three-factor formula, they're looking at property, they're looking at payroll, and they're looking at gross income, right? So when we're doing that, your payroll factor is still, if they're based in the New York office and they're telecommuting, the state's going to say the payroll factor is 100%. The property factor is kind of where your rent is, your lease is, until you change that could be 100%. And your gross income factor in New York, it's an archaic rule, but the gross income factor, which is designed to be like a receipts factor, but it's based on where the chief office is or the primary office is. So 100% in this example, probably for a New York City-based hedge fund, probably even with folks working from home for New York State purposes. Again, for New York State purposes, there wouldn't be probably much savings again in the short term. People start closing offices, you start making employees remote on a permanent basis, then you could probably see a difference, but at least for now, you're not going to see that. All right, we actually only have one kind of polling question, but our first polling question here and our only one, just in terms of what you guys are seeing here, after we get through this, hopefully that happens eventually at some point. What do you think you're going to be doing? Your employees are going to be doing? They're going to be working at home all the time, most of the time, 50-50 or rarely. We're hearing all sorts of different things. I can speak from my own perspective. I kind of don't mind it. I might be somewhere in between A and B. I expect a lot of my colleagues like to work in the office, and good for them. That's great. I don't mind working here. I mean, I sometimes get interrupted by some of my children, but most of the time they respect my privacy. In fact, a lot more than my colleagues respect my privacy. So polling question is 50-50. Actually, 50-50 is, folks think that's the 63% of people say 50-50. So again, that of course is a change, right? So let's talk about how that work at home issue is going to overall affect the UBT. All right, so look, the UBT, it's a little bit of a different animal. It's an entity level tax on an unincorporated entity. It's called the unincorporated business tax. Shocking, So corporations in the city pay either the general corporation tax if they're an S corporation, or the business corporation tax if they're a C corporation. But entities also pay tax. They pay this UBT, unincorporated entities. And it can be sole proprietorships too. It's not just partnerships and LLCs. So the rate of tax is 4%. So it's imposed at a 4% rate. And there's some exemptions. Like one of the exemptions is, purchase and sales of securities for your own account. There's a real property based exemption if you're in the business of holding, leasing, or managing real property, and other investment activities. So there's a couple exemptions, not necessarily relevant here. What's relevant here is this question around sourcing. Okay, so sourcing, the issue is, if I'm subject to the UBT, I don't necessarily have to pay tax on 100% of my unincorporated business tax income. Instead, I'm paying tax on only the source, whatever source of that income is coming from New York City sources. I'm actually going to start at the bottom of the slide here, the last bullet. So if I'm a service provider, I'm paying tax based on where the services are performed, right? So it's a single factor. The only factor used for the UBT is based on where services are performed. So that's the first thing to keep in mind. And that's a key factor when we're talking about this work at home situation. So single factor where the services are performed. So we're going to come back to how that impacts the home office situation, but then let's go back up to the top of our slide here. So the rules don't, guys, can you just hold on one second? I'll be right back. Hold on.
Guess it's the piano practice time.
So see the joys of working from home. My kid was practicing his piano. So what are you going to do? All right. So one of the questions we had is, okay, well, you look to where services are performed, but some folks we've talked to about this issue have said, well, wait a minute. If my only office is in New York City, am I allowed to slice and dice my apportionment percentage? And the answer is, yeah, you are. It used to be that you couldn't apportion income if you only had an office in New York City, but now you can. So that's one thing. There are special rules out there for registered broker-dealers. I think absent unusual circumstances, I don't think an entity like a hedge fund, of course, like a law firm, like other service providers, they're probably not registered broker-dealers. But interestingly, if you are a registered broker-dealer, you use a customer-based sourcing. So again, you have all your income, how much of it is New York City source. The typical rule for service providers is where the services are performed, okay? But for registered broker-dealers, it's where your customers are. And it's funny, a lot of states and localities are migrating towards that, okay? So they're migrating towards customer base. And in New York State, we actually are. It's customer-based sourcing for S corporations and C corporations. And at the city level, it's customer-based sourcing for C corporations. So there's a lot of migration to that, but not here. And look, if the city UBT was based on customer sourcing, we could end the webinar now. Like there's nothing really much to talk about in terms of where services are performed, but it's not. So again, it's not a three-factor formula like that state percentage. There's only one factor. It's where the services are performed. And this is where, again, the work at home thing becomes an interesting discussion point. So a couple other things. So there's a ruling out there, a finance letter ruling from New York City in 2018 And this was just one guy, so it was like a sole proprietorship. But it's instructive to sort of how I think this is, not sort of how it plays out, but why it sort of could work here, or why there could be a savings for folks who have people now performing services at home. So here again, it was one guy. He was, had maintained a small firm in Long Island. It doesn't say whether he worked out of his home. You sort of get the idea that his office was his home, but he sometimes came to New York City. And what the ruling said is, okay, well, if work for your client is inside New York City and outside New York City, you allocate the receipts from that client based on the proportion of time spent in the city. Proportion of time spent in the city. So there you go. There's the hook there to sort of bring us into where the services are performed. So the takeaways from the statute, and then again from the finance letter ruling, focus on the location where the services generating the charges are performed. Okay, look to where those employees are who are generating those services, and importantly here, there does not appear to be, and I guess I should say it more definitively, there is not a convenience rule aspect to this test, right? So in this finance letter ruling, they didn't say, well, if you're working from your home for a New York City person, we're going to treat that as a New York City sort of day. They didn't say that. They didn't say that at all. And there's no sniff at all in the statute, any regulations, any other rulings that there's well, if you're telecommuting to a New York City office, we're going to treat that as a service performed in New York City. No, there's nothing like that. And remember the example I gave of the hedge fund for New York State purposes, where you have basically if the main office is in New York City, then the receipts are deemed to be in New York City. That's not the rule here either, right? Doesn't matter where the main office is. Go back to the statute on the previous slide. It's to the extent services are performed in the city. So again, we'll get to an example of how this works later, but the whole sort of, the takeaway here, the main takeaway here is UBT bases it on where people are performing their services. And if, your employees have scattered, your service providers have scattered to different locations outside New York City, well, now we have an issue, a good issue potentially, where that apportionment percentage can now be significantly probably diluted because you have services being performed outside New York City. So that sort of is the concept, right? That's the legal basis for the concept that, maybe the UBT here can be reduced. So the next question is, well, how do you do the math, right? So this gets a little more complicated. So again, we go back to that finance letter ruling from 2018. And what actually the city said there is they said, well, look, if different tasks are performed at different rates, then you could calculate it separately. So I think what they meant here is if for company A, they billed out at $1,000 an hour, and for company B was billed out at $200 an hour, and company B was in the city and company A was in Long Island, well, then there'd be a different weighting, right, as to how that service provider would allocate his services. Again, more weighting towards the client who paid $1,000 an hour than the client who paid $200 an hour. So they looked at weighting there, and the GCT, so the general corporation tax, sort of the old generation general corporation tax in the city, says something similar in their rules about how they would allocate services under the old New York City GCT rules. Same kind of thing. Look to the relative values of amounts of time spent in performance of such services in the city. So again, the focus is on performance of services in the city, and that there could be, again, some weighting towards that. So lastly, just in terms of some background, the provision I just mentioned from the general corporation tax came up in a case a couple years ago, and it really sort of, I think, finishes our analysis on this UBT issue, because again, we start with the notion that we look to where services are being performed, right? So we got to do that. But now when we have people performing services in different places, how do we count those? How do we count that up? And most specifically, who do we count? Like, who matters, right? We're talking about the performance of services. Does it matter? Do you take every employee and count where every employee is working? What the Gerson-Lerman case says, and it goes up to the New York City Tax Appeals Tribunal, it's a precedential case. There, the taxpayer provided a mix of investment advisory services, consultation. They had a group of like experts that weren't employees. They were called council members. And they were like experts who the company's clients could consult with, like conference calls, meetings, that kind of stuff. Plus, the company had employees who were research folks. The company had sales folks, and they had back office people. So the case went through different twists and turns, but in the end, the tribunal said, well, hold on a second. We need to look at who's generating the revenue here, right? And the city said it was, it was only the employees and it was only the research guys. The taxpayer wanted to say it's really our salespeople who are generating the revenue here. And the tribunal kind of said, well, there's a lot of people involved here, right? The tribunal said these independent contractor folks on the council, they're valuable. The research folks are also valuable. The salespeople are valuable. Oh, and by the way, the IT guys who set up the system where the council members can talk to clients, they're pretty darn good too. So the city was like, let's look at all of them. And so the city based the receipts factor there on the compensation of all of these guys, right? So, and it was almost like what the tribunal did was do basically like a payroll factor. So they didn't assume, and I don't think there were facts in the case, that people were providing services in different locations, right? The issue we have in our situation. But Gerson here is relevant because this notion that you have to find the income generators, right? So you look to the location of the individuals generating the charges for the services. In the Gerson case, they thought, you know what? There's a whole group of people who are sort of contributing to the revenue coming in. So let's look at those different groups of people. We're not going to look at back office people, right? We're not going to really look at non-client facing people really. But we will not just look to employees. We could look to independent contractors as well. This will be relevant in examples for hedge funds and law firms when we get to those, because obviously you have partners of those businesses who aren't employees, but who are sometimes the driver of the services. So it's not a payroll factor. It's looking to who's generating the services. And lastly, both of these cases talk about the weighting, that there could be disproportionate weighting between different service providers. So again, that's definitely going to be relevant as well. So again, yes, that's kind of the legal framework for the overall concept, that if you are a UBT taxpayer and you now have employees who are no longer working in New York City, maybe before you were 100%, right? Everyone was working in New York City. Now people have spread out. These cases, the statute lays the groundwork for saying, you know what, there could be an ability to actually limit your UBT based on where these folks are doing their thing now. Okay, so let's kind of talk through a couple examples. And by the way, I'm seeing folks who have questions popping up. The plan here we're going to do is just we'll last 10 minutes or something like that. We'll answer questions. So if you popped a question there, I can see them popping up. We'll definitely get to those at the end. All right, so a couple examples here. First one, let's just use the example of a typical hedge fund management company, and we'll just keep it small for purposes of the mathematical computation here. So we have 2 partners, 4 analysts, 8 back office people. Historically, not a lot of travel. Let's just, it's a 1 New York City office, so didn't travel a lot, but it closed in March 2020, like many offices in the city closed, and let's just assume it's going to be closed for the rest of 2020. So once it closed, well, now one partner goes to Connecticut, another to Florida, 2 go to their parents in New Jersey, and a couple just hunker down and they're in Brooklyn. So now we have sort of these 8 folks, and the back office people I haven't listed here, but let's say the back office people scatter as well. So for the sake of the example, let's say there's $20 million in management fee revenue and $10 million in taxable income for unincorporated business tax purposes. Now, look, some of you might say, well, that's weird. A lot of times management, companies are able to, reduce their fees to nil, right? Because of other expenses, and that's fine. If you can do that, that's a different seminar, right? Good for you. You may not need this. The other thing to point out here is, of course, a hedge fund will have another sort of stream of income that flows through to its partners from a different entity, right? Not generally from the management company, but that's the carry. The carry isn't subject to UBT. So we don't have to sort of worry about planning around that. That's already set. What we're talking about here is sort of management company income, ordinary income that flows through to the partners, but for UBT purposes, gets trapped and is subject to tax at the entity level. So in 2019, let's say this management company, 100% of services in New York City would have paid, $400 grand in UBT. I can do that math. That's pretty easy. So based on that 4% rate. Well, what about in 2020? So how does this math work? So, very rudimentary calculation we've done here, and we can walk you through it. But so let's start with the partners. And first, let's consider the idea that we think, remember, there's sort of 2 partners, 4 analysts, and 8 back office people. We're going to, no offense, but the back office people sort of don't count, right? They're not in client facing, generating receipts. So they're off to the side. We're going to look at the partners. We're going to look at the analysts. And in this example, we're going to weight the 2 partners at 50%, meaning that half of the sort of receipts factor is going to be determined based on where they're performing their services. And again, here we get to total days worked of 260. Interestingly, and Nishant, we got this question earlier, like, well, how do you count work days? It's actually, I have a lot of experience in counting work days in the New York State non-resident standpoint, because that is always a big issue. How do what's a work day in New York? What's a work day out of New York? Look, generally it's 365 minus weekends, minus holidays, minus vacations. The example here, we're using 260, maybe because the partners do some work on the weekends. They don't take vacations. It's a crazy year, whatever. So 260 days worked, but only 60 days worked in New York City. Why? Well, partner 1's in Connecticut. And the only time partner 1 was in New York City was in January and February. Partner 2 is in Florida. So again, same thing. So that percentage, 23%. So the 2 partners were sort of were weighting at 50%. Their average apportionment percentage there is 23%. Now we take the analysts, right? So the analysts will, they took a week vacation, so we'll give them 240 days worked in their denominator. In the numerator, again, how many days do they work in New York City? Well, analyst 1 and analyst number 2, who went off to New Jersey, they're like the 2 partners, right? They only had 60 days worked in the city this year, so their percentage is 25%. 3 and 4, well, they're in Brooklyn. So they're not at the office, but they're still within the boundaries of New York City. So those folks are probably, those folks are 100%. So the combined sort of analyst computation is 63%. So easy enough. If you can read the slide, we have the 2 partners average is 23%. The 4 analysts, 63%. Mush those together, divide by 2. The combined apportionment is 43%. So remember, last year, this firm was at 100% and paid $400,000 in UBT. This year, with this weighted apportionment methodology, they're down to 43%. Again, it's a savings of over a couple $100,000. And again, that's just 43% of their $10 million in management fee income times the UBT tax rate. So again, that's essentially how it works. When we're trying to, again, on a partner by partner basis, analyst by analyst basis, determine the work days and then come up with the methodology. And look, and I'll mention this later, it's not like I pulled this from regulation section 1, 2, 3, 4, 5. There's not detailed regulations that say, well, here are the partners, here are the people you pick, here's how you count their work days, here's how you weight their work days, which is good because it does give you the ability to do, something that's reasonable and rational. It'll give you a reporting position. The downside is, and we'll talk about this in a moment, but you look at the Gerson case, that Gerson-Lerman case, and the taxpayer had one method. The tax department, the city Department of Finance came up with another method, and then they went to tax court. The ALJ picked yet a third method, and then it went to the tribunal, and what the heck, they picked a different method too. So it does create a little bit of a kind of Wild West kind of idea that, there isn't anything that's definitively going to say, here's exactly how you got to do it. But again, it does give, smart people the ability to figure something out that makes sense, then that is defensible. Speaking of smart people, let's talk about a law firm. So second example is, again, another service provider type entity that's usually set up in a partnership structure, law firms, right? So take a law firm with 50 total lawyers, 20 partners, 30 associates. Again, we use 10 million of taxable income. And for here, again, we'll assume that the partners and associates generate the same amount of service receipts. I mean, obviously that's not the case. Partners will have a higher billing rate. So there could be some weighting competition, weighting in there, but for ease of the math, let's just forget about that for now. 20 of those lawyers in Buffalo, 30 of them in New York City. So before the pandemic, look, if the firm didn't do a workday type thing, and again, I think many firms do. In fact, in my firm, when I travel, obviously I have billing records, gotta pay the bills, right? So when I travel, I have time charges, and I know from my time, my assistant puts in, I'm in New York City. That ultimately filters down. One of the reasons we track that is for our UBT, right? To sort of see how much services are being performed in New York City. I live in Buffalo. I used to travel to New York City. So a lot of my services would actually be generating UBT, or at least would be going into the UBT factor. But in any case, to make it simple, let's just say 20 out of the 50 lawyers worked outside of New York City. So we had a 60% apportionment last year, resulting in, again, in 6 million subject to the UBT, and we paid, X amount of tax. Since March, of course, 25 of the 30 New York City attorneys are now working outside the city. 5 of them maybe still live in the city or hunkering down. 25 of them got out, right? Well, now we have 45 of the 50 attorneys in this firm working out of New York City. Now the percentage goes down to, I spared you guys all the math here, but the basic idea is now we're dropping down, at least for the last 10 months of the year, the amount of sort of the headcount in New York City. Now we have a much lower UBT percentage. And, I joke here, your own payroll protection program loan here, a significant amount of savings that you have as a result of, tinkering with that UBT computation. And again, the tinkering is all done around employees, partners too, right? Remember, partners are included. It doesn't have to be just an employee, right? This is not a payroll factor. It's all about tinkering with where they're located and where they're performing their services. It doesn't matter where their clients are, right? It doesn't matter where the main office is. And again, right now, there is no telecommuting rule for UBT purposes. So all good stuff, right? I mean, that's super interesting. This has been an issue that's popped up in the Wall Street Journal. It's been on Bloomberg. It was on CNBC the other day. It's coming up in a lot of places. And lots of folks are talking about it. I've talked to probably a lot of you on this webinar about it. And, seems like it should work. But the caveats here are few. First of all, there's no specific guidance here that says this is how you do it, right? And I've said that before. It's a little kind of Wild Westy in that regard. So now look, there's no guidance saying you can't do it, right? There's no convenience rule, as I said. There's no telecommuting rule. So based on the statute and regulations and policy proclamations out there, this works, right? There's nothing that says this doesn't work. However, guess what? As I said before, with respect to New York State, these taxing jurisdictions are not going to want to sort of be bleeding cash as a result of this pandemic, and they're going to be looking for ways. Look, raising rates, that's easy, right? That's a great way to initially increase revenue. But just like the state, I think, is going to be aggressive on convenience rule telecommuting cases, we just got to be careful here, or just keep in mind that as we're advising clients into this potential planning opportunity, that it could change, right? And could it change retroactively? I've seen it. I've seen states, localities make changes, make them retroactive. So we could see a legislative fix where they just change the law and say, oh yeah, there's a convenience rule effective, Jan 1, 2020. There could be an administrative fix, which is the easier route to go for a lot of these taxing jurisdictions. It's the way we see particularly a lot of taxing jurisdiction done or tax administration done in New York, which is we'll just issue a bulletin. We'll just issue a statute. It sort of is like, in the pandemic, the governor just issuing an executive order. Normally you got to pass a law, but you could do it quicker by just putting on a publication that says, oh, never mind guys, there's no convenience rule, or there's a telecommuting rule for the UBT. So we got to be careful of that. And probably I don't know if it's the biggest concern, but one of the risks is that there's an audit fix. And what I mean by that is nothing happens. Nothing happens this year, next year. We set up these plans, and then the auditors get it in a couple of years and say, what are you guys doing? The person was just working from home, but they were telecommuting to an office in the city. We think that's a city day. What's your basis for that? I don't know. I mean, sometimes they don't need a basis, right? So that is something, of course, to be careful of as well. But look, in the meantime, there isn't anything that says this isn't the way it's supposed to work. The guidance out there suggests you look at work days, right? And again, you could compare compensation levels like a payroll factor, but the typical way, and it's outlined in that private letter ruling, or that finance letter ruling, you look to where the guy was working, right? You look to the specific work days. So, I mean, in the meantime, I say, if you're willing, it is definitely a mechanism that, again, we think is worth the effort. We think it works. But that's step one, right? So step one is, what are the rules? How does it work? Let's see it in practice. The other part of this webinar we wanted to talk through with you guys was, what's step two? How do you track it? How do you figure it out? How do you know where people are? And that is where Nishant comes in to talk about that piece of it. So Nishant, if I don't screw this up, I will stop sharing my screen. You got to start sharing your screen, and then you can take over.
Tim, that was perfectly executed. You did not screw up anything. So good job.
Awesome.
You have learned the magic of Zoom. Thank you, Tim. That was excellent, very informative. Hopefully, lots of questions are popping up, so we'll get to those questions in about 10-ish minutes. But to Tim's point, really there is an opportunity here, and for the folks who want to give it a go, the question is how? How do you give it a go? Do you just try to claim the UBT savings and cross your fingers and hope that the tax department will not say anything to you because they already expected? I think for a number of folks, who I've talked to in the past, this starts to smell and feel a lot like residency, right? Where the state and the city are going to be aggressive. They are going to go after the guys to say, hey, you are trying to claim something that you owe us. And so I do expect that the audit rates on this will be high, which basically means that if you are going to go for it, make sure that you are well prepared, which, much like the residency piece of the story, is all about being able to document and prove where have the different individuals of the firm been. And because the burden of proof, like in residency, lies on the taxpayer, so it is important that the taxpayer be able to produce the clear and convincing evidence to be able to prove where the individual is, whether they are working out in New York City or working outside of New York City. Now, we've known, like from the residency world, that the state will accept a number of different kinds of documentations, handwritten calendars, diaries, Excel files, credit card receipts, all these things that have been used in the past historically. I think you probably know from your experience, if you've had one with residency cases, just to be able to keep tally of all these things for one individual is a nightmare. So when you start to think about a firm that even has 5, 10, 15, 20, 30, 50 people, now you're talking about a complete nightmare. And that's basically what we see in our client base, which is why in the 21st century, thank God that, we don't have to rely anymore on shoeboxes of receipts and, going out, running out in the COVID world with your mask on just to be able to swipe a credit card, but rather be able to leverage technology that does exist out there. So technology obviously is one piece of it, as Tim talked about. It's basically both those things going together, the law and the tools that you can use to support. There are multiple ways of documenting these, where people have been. The app on the phone, which I know many of you and your clients use for residency purposes, obviously that is a very, very good option. As I talk to a number of service provider firms, a number of financial services firms, that is basically going to give you the best quality of data that you can get out there to be able to prove in a very, very convincing way where an individual has been and how much time they've spent in different tax jurisdictions. But that doesn't have to be the only way that location of employees can be aggregated. There are other methodologies which include applications that can run on laptops. There are VPN records that most IT departments keep that can be sucked into a system to analyze it and to be able to understand what the distribution of people may look like. But at the end of the day, what mechanism you use to determine where people are is really specific to the culture of the organization. It is very specific to the needs of the individual. And the good news is all sorts of tools are available out there that can basically get you that balance between how do you, in an auditable way, capture that information while balancing the privacy and security of the employees. And then at the end of the day, all of this information needs to be documented. It needs to be auditable. This is my own snapshot from the application Monero that I use. This is from the good old days in March, still in early March, when I used to go from Westchester into New York City for the day. So arriving at 8:15 and leaving at 6:30. Those are the good old days. My calendar now looks all New York, no New York City. So it's a little bit of a bummer. I'm not going to New York City, but to Tim's point, that is also where the opportunity lies, right? And then at the end of the day, just being able to look at this information, both as an individual, but also being able to delegate that out to service provider firms so that, the right calculations, so that service providers can assist their clients with the right calculations and have the right data and analytics so that the reporting, et cetera, can be done in a timely and an accurate way. I think that's the important piece. So that's basically, at the end of the day, if you are going to give it a go, then my recommendation would be to make sure that you are keeping good records and make sure that if you have a population which goes beyond one individual, for which, you can always use Moneo's personal edition. But if it is going to be sort of a few people, then certainly worth considering how do you start to aggregate that information across multiple folks so that it can feed into the assumptions that you're making about the UBT savings that you may potentially have, and to make sure that you are audit ready. So with that, as promised, Tim, I have left 15 minutes for question and answers. I know there's a lot of questions that have come in. And so you want to kick off with some of the questions that have come in?
Yeah. First question, and some of these questions, guys, are, and I'll answer them all. That's fine with me. Some are based on sort of the New York State stuff I was talking about as well. So happy to hit those topics. We have a few minutes. And again, if we don't get to your question, tough luck. No, I mean, we'll answer them after we have your questions. We have your contact information. So one of us will reach back out to you and answer your questions if we don't get to it live. So first question is, how does New York, and this is really a state question, how does New York State view partnership income in New York for part-year residents? Now, again, I think this is overall pretty relevant because what you might have in 2020 is a lot of folks who've said, you know what, it's time to go. I'm moving, and people are really moving. They're not fake moving. They're really moving to another state. So in 2020, they're going to be part-year residents. So let's say they moved in April 2020. So in that case, they're going to be a part-year resident, right? They're a resident of New York State, maybe New York City up until the end of March, and then for the rest of the year, they're non-residents. Well, what do you do for partnership income? Well, New York has a statute that says normally partnership income is allocated pro rata throughout the year based on the number of days you are resident and non-resident. So in that case, whatever 3/12 of the income will be in the New York resident period and city resident period, so 100% tax on that. And in the non-resident period, it'll be only the New York source income. So no New York City tax on the 9 months of flow-through income on this pro rata method. and maybe state tax, but state tax will be based on that three-factor formula that I talked about at the beginning. What's interesting here, though, is the statute also says if in the event, basically, you can tell when the partnership income was received or accrued, well, then you can allocate it on that basis. So if there was a significant transaction through the partnership at the end of the year, well, we're going to treat all of that as non-New York, as non-pro rata income, right? We're not going to prorate that piece. We're going to do it based on sort of like an actual receipt method. So that's a very important piece of this when we're looking at someone moving from one place to another, how that partnership income works. So next question. And this is, I think, the sort of takeaway from the topic. So if there's no convenience rule, a New York CPA firm that had all of its employees working from their homes outside New York City during the pandemic, those receipts will not be sourced to New York City for UBT purposes. That's right. That's the whole ball game here. That's definitely the point. So that, good for that CPA firm if that's how it works. All right. Next question from Rob. This is a good one. So you remember the issue, Rob's question is, will Connecticut allow a credit for taxes paid to New York State under the convenience rule? So again, this is a telecommuting situation, but it's not our UBT situation. This is me, I'm an employee of a New York firm. I'm working from Connecticut, but I'm telecommuting. So remember I said New York is going to say my wages, even though my days are not in New York, New York is going to say, but we get to tax it because you're telecommuting into a New York office, right? Well, what's Connecticut going to say? Well, a couple of years ago, Connecticut would have said, too bad, so sad, we're taxing you too, and there'd be double taxation. But just oddly, a year or so ago, Connecticut, after years of kind of butting heads with New York on this issue, decided, you know what, we'll give a credit for taxes paid to New York under New York's convenience rule. Connecticut still has the rule that working in Connecticut is a Connecticut day, but if New York is taxing under the convenience rule, Connecticut is actually giving a credit. So again, that's a state question, but that's an important one, that there will be a credit. Let's see here. Question: can I have a copy of the presentation material? Yeah, Nishant, we're going to send all those out, right?
Yes.
The webinar, this slide deck. Okay, we got to get all your cool slideshow pictures to the group here. We can't leave them hanging there. Okay, so next question. So New York City resident with a home in the Hamptons. And again, this is slightly off topic, but all these things sort of relate because especially since a lot of the folks moving are partners and entities that are subject to the UBT. But this is the question that I probably get about 17 times a day. So the question is, New York City resident, I got a place in the Hamptons. I've been there since March. It's March 12th actually is when everyone says they went there. And I'm going to be there for the rest of the year. So no New York City taxes for the last 9 months, right, Tim? No. I mean, that's what I said at the outset here, guys. You can't just turn off the New York City tax on and off like a light switch. In order to be able to claim a move to the Hamptons in March of 2020, you kind of really got to move there, right? You can't just go there for 9 months and say that was a permanent move. And the interesting sort of part about this is hindsight's going to be 2020, no pun intended. In other words, 2020 happens. This year is completely nuts. Hopefully things end up getting back to normal. But in this example, if this taxpayer tries to claim that they moved to the Hamptons and they filed that tax return in October of 2021, it gets audited in the summer of 2022. Well, if that taxpayer's chilling in New York City, going to Broadway shows, and not in the Hamptons other than in the summer, the city is going to say, sorry, you didn't move. That was you just sort of ducked out because of COVID for a little while. So again, the hindsight thing is really going to be big in these sort of pandemic related moves. If on the other hand, in 2022, you're chilling in the Hamptons, kids are in school out there, life's good. Okay, then it's certainly a different story. But the proof is going to be in the pudding a couple of years down the road. If the argument is, well, we just moved out temporarily under New York's residency rules, you didn't actually move at all. Next question. It's an interesting one. So what are thoughts on New York City contesting the allocation? So this is the UBT, where services are performed allocation. based on the employees VPNing to the New York City office in order to operate systems used in the businesses, saying that they were really in the office, like, they were virtually in the office by touching the server that's in the New York City office. I mean, I don't think so. Like, that's telecommuting. It's kind of the same argument. The city would have to, basically, to make that case, they'd have to make the argument that there essentially is a telecommuting rule. I don't know that the use of equipment in the city matters, because remember, there's no payroll factor here, right? There's no, there's no property factor. So it doesn't matter where the property is. So I think it really is where the services are performed. And the VPN equipment isn't performing the services, right? The service provider is the one providing the services. Okay, next question.
Hey, Tim, before you move on to the next one, I think we missed one, which is an interesting one. So it's basically about private equity funds and how they get paid 2% in management fees, irrespective of obviously where services are being performed. So the question is, how would you allocate the 2% management fees, if at all, for UBT purposes?
Well, I mean, I think it's the same thing. So, Nishant, when you say, and maybe it's Alan's question, not your question, but 2% management fee regardless of where they're located, like, I don't, for city allocation purposes, it doesn't really matter why the customer is paying the receipt, right? The issue is management fee they get a 2% management fee. Again, okay, I get it. Doesn't matter where you are or where you're doing it, but for city allocation purposes, the income that flows through because of that management fee has to get sourced, and it'll get sourced based on where the services are performed. So that's I think the answer there, Alan, is we would look at, if there's, in the easiest example, there's five income generators basically, or receipts generators in that fund. They might all used to be in New York City, and they're going to get 2%, and now they're going to be in different places and they're going to get 2%. For purposes of allocating that receipt, we're going to look to where they are, like where they're performing those services. So again, it might not matter for purposes of, where they are for purposes of who's paying that 2%, but the city cares where they are, right? So they allocate it based on where the service providers are. Nishant, you think that was the gist of that question?
Yeah, I think one clarification on that, Tim. So in the UBT calculation itself, obviously the management fee will be a big component of that, right? 2%.
Sure. Yeah,
that will be the big portion of the revenue that comes into the firm, and then you'll have expenses paid out, and that's basically what's going to leave your net that you then apportion out.
That's right. And if the expenses, and this happens in a lot of management companies, the expenses rise to the level of the management fee revenue, well, then there's no income and there's no UBT. So a lot of management companies have structured themselves in such a way that they're not paying a lot of UBT anyway. In which case, this idea isn't really all that important. But this issue just doesn't apply to the hedge fund management company who might have that set up. It applies to any partnership in LLC, so that's a service provider. So it's very wide in its breadth. So next question, going back to the convenience rule. On the convenience rule, how easy or difficult is it to prove that your employer moved you to another state for their own convenience? So this is, it's a common problem. And really the question here under the convenience rule, it's really, did you get moved to another state out of necessity? Like, was there a reason that necessitated you working in another state? Or did you work in another state because it was convenient for you or even convenient for your employer? The interesting legal argument that I think is going to come out of these pandemic cases is no one, I shouldn't say no one, any non-essential business, if you're an employee of a non-essential business, it was a necessity that you worked at home outside the state or wherever else outside the office. It was the law, right? In New York, if you were a non-essential business, you had to work at home. If you were an essential business, you didn't. So then the question is, well, is it necessity if the employer is like, look, we want to keep our office closed. We have a 50% capacity or 25% capacity, whatever it is. So we're gonna encourage you to work at home. I think the state is going to be very aggressive on this issue. And And we might even see some formal changes where they say, you know what, telecommuting is telecommuting. We're going to take those days. So there is, to Omar's question here, I mean, there is a whole sort of framework of factors that you can employ in sort of determining whether or not a home office should count as a real office. That's a completely different topic. So that is definitely something that one could look into when you're trying to prove these things. But that convenience rule issue, and again, Omar, I can send you some details on that if you shoot me an email. All right, next question from Kenneth. Individual Schedule C filer living in New York City with no employees. This is like that private letter ruling example. Has been telecommuting since March for a commission-based business. Can all fees earned from March forward while working in Long Island be apportioned out of New York City? Yeah, they absolutely can. And that's I think you look at that finance letter ruling, Kenneth, that was in earlier in the slides, and that suggests that where the services are performed are important. And then, to tie it all together here, Nishant, that individual Schedule C filer, has got to be able to prove, certainly it'd be easy for someone to prove that they didn't come into New York City in April, okay, because like nobody was here. But now it's more open, and this becomes almost like a day count case, right? This person is going to have to be able to prove that they prove the negative, that they didn't come into New York City during that period of time. And again, that's where the stuff Nishant talked about, definitely comes into play. All righty, we've got a couple more minutes here. Question, if our computer systems are outside New York City, does it count as telecommuting to New York City? Well, I mean, for purposes of, the answer I think is no. I mean, it's where your offices are is relevant, but again, that's only relevant for the state convenience rule, because the state convenience rule is going to, basically suck the days back as New York days if you're telecommuting. The city is not going to do that anyway, at least under our current interpretation of the UBT. So, but in any case, where the computer systems are isn't relevant. It's where the desks and the chairs and all that other stuff is. Next question. Okay, good question. Just to confirm for New York City UBT, it does not have to be a permanent move. And thanks for that question. So yeah, the residency piece of this, if I want to get out of paying New York State or city taxes individually, I got to get out of Dodge, right? And it's got to be a permanent move. This New York City thing is really completely different. The employees could be out of the city for the next, for 9 months of 2020 on an absolutely temporary basis. It doesn't matter, right? If their services in 2020 are being performed outside the city, then those days will not go into the computation of the New York City apportionment, period, and a sentence. It doesn't matter if it's permanent or temporary. It doesn't. So question from Lou. Can you see can you see states pass legislation during COVID-19 that there will be no allocations allowed based on where people are providing services? So it's interesting. There probably are, I think, 10 states who have sort of come out on this issue. We have a blog post on my website that we're updating that on sort of a weekly basis as more states say something. Louis, I think we're seeing both. I think 8 of the states have said basically the New York convenience rule approach, which is if you're telecommuting into our state, we're going to tax it. But a couple of states have said if you're working at home and you're telecommuting into another state, we're going to tax it, right? And there's going to be some headbutting there as well. So there's going to be an issue as well. So yeah, if you want, just check out the Noonan's Notes blog. There's a great little chart there that sort of tracks this all the way. Next question is from Susan. I skipped this question before because I don't know the answer. So Susan, I'll look. So the question is for the MTA tax, how that would be calculated if someone moves out. Gosh, I haven't actually looked at that yet, but here we go. I will. So Susan, I will, send me an email after this, and I absolutely will find you that answer. All righty. So Nishant or Holly, we got them all?
Yeah, it was wonderful. Thank you so much for doing that. And there was so many questions we had through. So thank you for answering all of them.